Stop what you are doing right now and listen to me very carefully because you are being lied to about real estate investing. Every single guru on the internet wants you to believe that buying a rental property is your golden ticket to instant freedom, rich passive income, and early retirement. They paint this glorious picture of tenants paying off your mortgage while you sit back on a beach collecting checks, but they are hiding the financial slaughterhouse that happens when reality sets in. If you are actually thinking about buying a property for real estate rental investing, you need to hear the brutal, unvarnished truth about why you are about to make the biggest financial mistake of your life. Let us break down the 10 reasons why buying a rental property will completely destroy your finances. Reason number 1, absolute illiquidity. Real estate is a dead asset when you need cash in a hurry. If you face a catastrophic personal emergency tomorrow, you cannot just tear off a kitchen counter and sell it to pay your bills. Selling a property traditionally takes 60 to 90 days just to close, and that is assuming you even have a buyer. If you are panicking and need to offload that house immediately, you are forced to slash your asking price by 10 to 20% below current market value just to attract a cash buyer, completely wiping out whatever equity you thought you built. Reason number 2, devastating entry and exit friction costs. You are bleeding massive amounts of cash the exact second you enter and exit the deal. When you buy a $300,000 property, acquisition costs like lender origination fees, appraisals, title insurance, home inspections, and transfer taxes will immediately consume 3 to 6% of your total purchase price up front. Then, when you finally decide to sell it down the road, agent commissions and closing fees will swallow another 6 to 10% right off the top. You are literally throwing away up to $48,000 total just moving the deed around from one hand to another. Reason number 3, the big passive income lie. You are not buying an investment. You are buying a second job in a low-margin operating business. Plan on spending 100 to 200 hours every single year dealing with contractor bids, lease disputes, accounting nightmares, and midnight emergency phone calls when a pipe bursts. And if you try to dodge that headache by hiring a property manager to handle it for you, they will take 8 to 12% of your gross monthly rent plus leasing placement fees, which instantly crushes your net yield into the ground. Reason number 4, volatile interest rate exposure. Financing variables can turn a cash flowing asset into a monthly deficit overnight. If you buy in a fluctuating market, a mere 1% increase on a $250,000 mortgage shifts your monthly debt service by roughly $150 to $200. Over a standard 12-month period, that is an extra $2,400 straight out of your pocket, eroding your razor-thin profit margins in high-rate macro environments. Reason number 5, high-risk tenant default. One bad occupant can legally hijack your asset for months while draining your financial reserves dry. The average legal eviction process takes anywhere from 30 to 120 days, depending on your local jurisdiction. During that entire timeline, you lose months of rent while racking up legal fees averaging $3,500 to $700 in court and attorney costs alone, not including the thousands more you will spend repairing the physical damage they left behind. Reason number 6, relentless maintenance overheads. Things break, and they always break at the absolute worst possible financial moment. You are required to budget a minimum of 1 to 2% of the property's total value every single year strictly for routine maintenance. On a $300,000 home, that is $300,000 vanishing annually. Furthermore, a single major component failure like a full HVAC system replacement or a total sewer line collapse will cost you $700,000 to $15,000 up front, wiping out multiple years of cash flow in a single afternoon. Reason number 7, unforgiving vacancy periods. Tenants leave, and empty days equal pure financial loss. Industry averages dictate factoring in at least 5 to 8% of your annual gross rent strictly for vacancy downtime. If a tenant moves out and your property sits empty for just 60 days looking for a replacement, you lose 16% of your annual revenue while 100% of your fixed mortgage, insurance, and property tax bills remain due and payable on the first of the month. Reason number 8, singular asset concentration risk. Unlike the stock market where you can instantly diversify your capital across thousands of global companies and sectors, real estate traps you. Putting $50,000 to $100,000 down on a single property means 100% of your financial risk is tied to one exact street corner, one local municipal tax base, and one regional economy. If a major local employer shuts down, or the neighborhood declines, your property value drops by 15 to 30% instantly, with zero safety net to catch you. Reason number 9, hostile regulatory and tax shifts. Government interference can upend your financial projections overnight. Local property tax reassessments can spike your annual holding cost by 10 to 25% the moment a municipality adjusts local valuations. Furthermore, sudden rent control legislation, tenant rights laws, or forced tenant relocation assistance fees can legally cap your rental income upside while slapping you with thousands of dollars in compliance penalties. Reason number 10, dangerous emotional overextension. Buying a rental property based on social media hype leads straight to terrible math. Over 70% of amateur investors fail to run a strict 50% rule, which proves operating expenses consume at least half of gross income, and they fail to calculate a true cash-on-cash return. They buy properties yielding less than a basic high-yield savings account just for the emotional ego trip of calling themselves landlords. Do not fall for the trap. Wake up, run your numbers, and keep your cash safe.